think the economy is slowing, and I also think that it's slowing in a not normal way. The really only way to get that marginal energy is through natural gas. There's a lot of other sectors, not really AI related, that are lagging. So the general economy is being supported.
Okay, guys, so today we have Michael Lebowitz, who is a portfolio manager. And I'm very excited because today we will discuss the state of the current economy, we'll talk about the recent economic numbers, and we will discuss other very interesting topics such as the commodities, energy, and everything that's going on right now. So Michael, thank you so much for being here.
Oh, it's great to be here. Thanks for having me.
Thank you so much, Michael. So I would like to begin by talking about what's going on with the economy now. We recently had a lot of numbers. We had the economic numbers, we had the inflation numbers, we had the employment numbers. What's your take on what's happening right now?
I think the economy is slowing, and I also think that it's slowing in a not normal way. So we have this large influx of capital expenditures or spending into data centers, AI, the big companies, the Microsofts, Microsoft's earnings the other night, they said that just the numbers they're spending are enormous. And, Google, all these companies. And it's having an impact, a good impact on positive impact on the economy. I think at the same time, there's a lot of other sectors, not really AI related, that are lagging. So the general economy is being supported by this stimulus of sorts. It's not a government stimulus, but it's an economic stimulus. And at the same time, I think we're seeing the broader economy starting to falter a little. And I think the evidence was in today's employment number. There were I think it was 77,000 new jobs, which is okay. It's below average. We should be growing at about 150, 175,000. So it's weak, but it's growing. But they revised the two prior months each down by a total of like 250,000 jobs. So now we've learned that our job growth over the last 3 months has averaged about 30,000 a month. That's poor. That's very poor. And that's further confirmation from the BLS that we weren't getting before those revisions. We knew it was a little weaker. Now we know the economy's been a decent amount weaker. And look, we see it. Wage growth has slowed considerably. Job openings are falling. Nothing tremendous, but it's this general weakness that we're seeing creep in more and more as we get further and further away from that pandemic stimulus so long ago, but the lingering effect has been so strong. So the question is, can AI data center and infrastructure build out offset a poor economy? And the problem with that is that personal consumption, what me and you spend, is about 70% of the economy. So, a little reduction in our spending can offset all the benefits from this AI build out, which it does affect all of us, but it's a much more narrow contribution to the broader economy. So that's my concern at the moment, is that the broader economy continues to slip. The Fed doesn't really notice it because they're looking at the big macro numbers, which are buffeted by AI. And we saw that on was it Wednesday, when the Fed didn't do anything, which in hindsight, with the employment numbers, looks kind of pathetic right now.
And Michael, what's your take on the stock market, the S&P, the Nasdaq? How are they performing, and how do you think will the economic data that we had, will that be enough to move the markets, or what do you think's happening right now?
Well, today's interesting. It's Friday afternoon. The markets are down about 1.5%. It's hard to know why. Trump put out a bunch of tariffs last night, but the market prior to this hadn't really been reacting much to tariff news, good or bad. And then we got the employment number, which shows, more clearly that the possibility of a recession has increased, certainly than it was. So we're getting a negative reaction. That said, the market was getting decently overbought short term. We needed some sort of minor correction. I'm not talking about a 20, 30, 50% but the market just to remain somewhat healthy needed a 3-5% decline, or just a period of consolidation where it did nothing. And so maybe that's what we're starting to get right now. Now, when you kind of look longer term, my concern is that valuations are very stretched. And valuations are a tough way to predict current price movements. They're a great long-term indicator, but very poor short-term indicator. So always in the back of my mind as portfolio manager, I'm thinking about that. When will valuations normalize, and how will they normalize? Will they do it slowly over time, basically letting earnings catch up to prices? Or will they happen all at once, like 2000, 2008, more 2000 than 2008? So, short term, I think, we could sell off 3 to 5%. And before you know it, we could be roaring back to the new highs because retail has learned to buy the dip. It was, we saw it during COVID. The world was coming to an end, not coming to an end, but it was shutting down. And as soon as the Fed came in, people started buying. We saw it in April after the tariffs. Market was down about 15% from its highs. We were very uncertain about how this whole tariff thing would end up. It was, very concerning. Market started rallying, and then all of a sudden we're off to new highs. So, we could see a minor correction here that gets bought right back up to the highs, or this could turn into something more substantial. And that's where we use technical analysis to help us guide us through this process, whatever it may be.
Yeah, so Michael, you mentioned that retail are trained to buy the lows right now. But historically speaking, we have seen this story before in the early 2000s, in the late 90s, right?
Yeah, absolutely. So if you go back to the late 90s, the internet was the new big thing. The internet was what the AI is today. And if you go back to like 1995, that's where the internet narrative started gaining steam. So from 95 to 98, the market had just a beautiful upward slope. Nothing egregious, but it was just moving upward and to the right on a graph. And at the time, it was the largest and most profitable companies that were leading the market. Then in 98, we had the Russian default. We had the long-term capital hedge fund failure, and the market fell about 20%. The Fed came in, they cut rates, and from that point in early 1998 to 2000, or I think it was October 98 to very early 2000, the market took off, but it was led by very high beta, speculative, non-profitable companies. So the tone of the market changed decidedly before and after that decline. And if you look at the current environment, so then you get to 2000, all the speculative stuff craps out, and the value companies, smaller companies, profitable companies did much better. And all those companies that were the next big thing, most of them went out of business. Some of them went out of business. Some of them became nothing. Companies, Microsoft was one of them. They ended up being great, but it took them 13 years to get back to where they were. So fast forward to today, and 2023, 2024, we had a similar rally as 95 to 98. It was very slow, unvolatile. And what did we have? We had the largest, most profitable companies led the way, the Magnificent Seven. They led the way. Come to April, we get the tariff storm, market drops about 15%. The market then just takes off like a rocket, similar to what it did in October 98. It's no longer the Magnificent Seven leading the way. It's more speculative AI, data center, crypto companies that are now driving it. Some of them may be great companies. I'm not, saying they're not, but you have a very different change in leadership, and it's a much more speculative group. It's not, say whatever you want about Nvidia or Microsoft, but they are making boatloads of money. They are growing substantially. These companies some of them aren't even turning profits. A lot of them aren't turning profits. And, so I'm not saying this is going to turn out like it did in the late 90s, but the similarities are kind of striking. Now, the thing to note is from October 98 to, let's call it March of 2000, so that's, almost a year and a half, that boom lasted. So, even if this boom is half the length of that boom, we still got quite a while here. So, it's hard. You have to be aware of valuations, be aware that most likely there will be a day of reckoning. Doesn't mean it's today or tomorrow. And at the same time, realize that this market can go much higher than anyone thinks it can. So, that's what we're juggling. Those are the balls in the air, and it's hard. But, if you have a good fundamental basis, foundation, and understand technicals and create risk levels so you know when to stop out, when to take risk off the table, when to put it on, you can at least sleep at night and manage your exposure.
Yes, certainly, Michael. So I would like to move to the to the bond market, but just before that, I've seen the chart recently, Michael, where it sort of showed that the stuff really hits the fan when the Fed cut the interest rates. Sort of the first rate symbolizes the start of, the economic problems. What's your take on that?
Well, if you think about it, the Fed starts cutting rates when the economy slows. So first of all, what are stocks? You're buying companies. You really are buying ownership of a company. And if you buy in a company, their earnings are really what you're buying. You're buying cash flows. So in a slower economy, in a recession, earnings tend to be less than they would be in a good economy. So the valuations go down. So when the Fed's cutting rates, they're doing it because the economy, most likely, not always, sometimes they're doing it because a bank or a hedge fund is blowing up. But when they're doing it for the economy, they're really telling you that they're concerned that your corporate earnings are going to be less than you thought they were going to be. So as much as the market cheers on rate cuts, it really doesn't want what they're cheering for.
Yes, and what's your take, Michael, on the bond market at the current levels?
So I like the bond market, and I've liked it for the last year and a half. Hasn't gotten me anywhere. Yields are about the same they've been now as they were, a year ago. Now, granted, it's kicking off a 4 to 5% yield, so we're not sitting here earning nothing either. But I'm still in the camp that the macroeconomic trends of slowing growth, slowing productivity growth, weakening demographics here and globally are just and increasing non-productive levels of debt from the government erode economic growth and are disinflationary. Bond yields are extremely highly correlated with inflation and to a secondary degree with economic growth. So I don't see any reason to think that those productivity growth trends, thus the economic trends, have really changed since before COVID. I think COVID and all the stimulus and everything that came with it, behaviors, everything else, warped the scene for a long period of time, for coming on 5 years now. But at the end of the day, I think those long-term trends persist. And I'm not saying rates go back to zero or negative like they were, but I do think rates are potentially going lower. Now, there's a lot of caveats to that. What if we get in a recession and the president takes a page out of the COVID playbook and starts writing checks to everyone again? My opinions can change quickly. And, so but everything else kind of left as is. Um, I do think that yields head decently lower. We're seeing today actually on that unemployment number, yields are down 10 to 15 basis points, while the stock market's getting hit pretty hard. So we'll see. I don't buy into the bond market narratives that these deficits are going to cause interest rates to rise. And I really don't think there's going to be much, if any, tariff inflation when you look at it in aggregate. I'm not saying that the prices of some things won't go up, but the prices of other things can come down. People will buy other things instead of the higher price things. And when you put all that together, I think the effect will be very minimal and short-lived.
Okay, and Michael, US dollar. So there's two camps at the opposites. One camp sits in the dollar, they predict the crash, they're waiting for the opportunities. The other camp, they look at this, a structure of the monetary system, it's inflationary, you need to buy real assets, the dollar is doomed, etc. So what's your view on the dollar as a whole right now? It's still the reserve currency, but also compared to the other currencies.
So it's been weak. It's down 10, 15% against a lot of currencies over the last 6 months, call it. But in the grand scheme of things, versus those currencies, it's in the middle to upper end of its trading range. So against other currencies, there is no long-term depreciation. I think the whole idea of the dollar going away is garbage. You can think whatever you want about the dollar, good or bad, but there's no replacement. And the world being globalization, and we can debate whether that's declining or increasing, but the world's always, from this point forward and going back, is always going to rely on international trade. We're never going back to the ice ages where you just traded with the 10 people that were within 50 feet of you. So in order to trade with other countries, you need a common denominator. That can be gold, it can be shells, it can be, it can be paper clips, you name it. It can be anything, but it's the dollar. And the reason it's the dollar, it became the dollar in the 1940s is because America, it has the rule of law. Other countries do too, but some of our biggest competitors like China do not. Russia doesn't. We have the largest and most liquid by far capital markets. So if you're a country, if you're Thailand or if you're South Africa and you hold dollars, you want to make sure you can A, put them in a safe place where you can trust that you get your money, and B, you want to be able to invest that money. You don't want to just leave cash uninvestable, and you want to be able to borrow dollars. The US markets are far and away the easiest place and safest place to park your money. The US has the biggest military, which certainly doesn't hurt either. And our economy is so much bigger than the rest of the world. I mean, consider we're what, and then you got countries like Germany that are around, and Japan that are 4 trillion. That's how much bigger we are. China is at 15 or 16 trillion is the next in line. So you put all that together, and I'm not saying the dollar is going to be here forever, and it's going to be in the year 2286 that every country is still going to be using dollars. But what I am saying is that for, I think, my foreseeable future on planet Earth, the dollar will be the currency that is most often used for international trade and for reserve purposes.
Okay, thanks for that, Michael. And moving on to gold. So, I hear a lot of people saying that the dollar should be backed up by something tangible like gold so that it puts a cap on the amount of currency units we can have so that the governments cannot print to infinity. So I would love to have your view on that, but also view on the general gold market and what's happening with that right now.
So first of all, let's start with gold. Uh, I own gold. I have some physical gold and I have gold in ETF form. And to be honest, I know as a percentage about what I own, but my physical gold, I haven't even looked at in 10 years. I bought it, 2003, 4, 5, somewhere in there. I know about where it is in my house. If you said you have 5 minutes to find it, I'm not sure I could find it. I know what room it's in. So I think of it as like my insurance policy. I don't look at my insurance policy. I don't really know how much my wife would get if I die, or if the house catches on fire. Um, it's a protection. It makes me feel good, uh, but it's something I don't look at. And gold constantly goes through periods where it's in vogue and it's out of vogue. It's very much in vogue because the government's going to default, right? That's what everyone keeps saying. They're just going to keep borrowing and borrowing away, and the dollar's going to be worthless, which I don't believe. I think gold is a nice play right now. But I think if real yields start coming back down a little bit, uh, they can actually, that may actually help them too, because then the Fed is starting to go back to their old ways of QE, of cutting rates. So that could be further supportive. But at the end of the day, uh, I, I like to think of gold as more of an insurance policy than I do a trading asset. Not to say you can't trade it. You can trade it very well, just like soybeans, just like corn, just like Bitcoin, just like IBM or McDonald's stock. They're all tradable assets, and I'm not telling anyone not to trade them. The way I think about it is as financial insurance.
And I was looking at a lot of stats about gold, Michael, and if you would measure the price of a house in US in gold in 1970s, right now it's cheaper to buy a house measured in gold than it was in 1970s. So that's something
Hmm.
very interesting as well. And if you look at its performance as a whole against S&P, it's done phenomenally well as well. Of course, it has cycles, as you mentioned, but overall, gold, if you can, I suppose, get in at the start of the cycle, gold could go 600, 700% historically. It's
So,
happened many times.
so here's the tricky thing with what you just said, and I'm not saying that's not true, but you can always pick a starting point and an ending point where almost any narrative is true. So earlier we talked about Microsoft. From 2000 to 2013, it was a dog. So you could have easily said that if you had Microsoft starting in 2013 to the year 2015, it's a crappy stock. But if you did the same analysis from 1995 to 2015, it's an amazing stock. It's tough when you do that because there's plenty of periods where the S&P beats gold. There's plenty of periods where bonds beat gold. Um, again, it's an asset, and it does protect you from the dollar losing purchasing power. But so do bonds, so do stocks, so do real estate. A lot of things do. And that's just a tool in your arsenal if that's what you want to use. So,
Yes, 100%, Michael. And so let's move to the commodity sector.
mhm.
What's your view, Michael, on so we have copper done really well. Now it fell back to $4 and a bit. Um, we have other. So I think there's a huge, like, if we want to go to where we think we're going, we need a lot more commodities. Almost, you can just pick the commodity. Overall, in the next 10 years, we need a lot of it. And with the mining process, it takes a long time to get the permits to build the mine and everything. So, what's your view on the commodities from the fundamental perspective for the next decade, and also about on the current prices?
So commodities here and now are really tough to play for exactly what you just said about copper. Copper had a huge surge and an equally huge decline purely because of Trump issuing tariffs and taking away tariffs or refining tariffs. So I think in a very short run, certain commodities are kind of dicey to play. You could make a lot, you could lose a lot, and it's all based on the statement of one person. Um, sure, commodities are always going to be in need, and they always have been in greater and greater demand. I mean, if you look at what China's built out over the last 25, 30 years, it's amazing. But and they've had enough commodities to do it. So the thing to consider is that yes, the availability, the supply of most commodities, not counting like grains, but more metals and energy and some of that stuff tends to decline over time. But at the same time, our technology gets better and better. So think about like oil. In the early 2000s, we were worried that we were going to hit peak oil. All of a sudden, they figure out how to do shale oil. Well, they didn't figure out, they knew it earlier, but they really perfected shale oil, and we're nowhere near peak oil again. Someday we'll be near peak oil again, and maybe they'll be able to turn water into energy, or they'll be able to perfect solar, or they'll find a better way to harness the wind or geothermal. So, and that holds true for a lot of commodities. Yeah, today we need lithium and cobalt to make batteries. Maybe we can figure out how to make them out of, cow dung, or who knows what. So the benefit of technology is it allows us to overcome supply hurdles in a commodity space. The one commodity that we are involved in today is natural gas. So the way we see this utility infrastructure, electrical build out that's happening in a big way is that the really only way to get that marginal energy is through natural gas. Not to say that solar and wind and nuclear aren't sources, because they are, but we are far and away abundant in natural gas. And I think that over the next 5 years, that will be the primary source that will be leaned upon to fuel it. Now, and when you start looking beyond 5 years, that's where innovations in solar and nuclear build out and other sources could kind of supplant natural gas. So, we're not, the problem with natural gas is it is incredibly abundant. They're burning it off because they can't economically get it somewhere to sell it cheap enough. So there's plenty of it. And the price is historically very low. But what we've invested in is the pipelines. They're not as nearly as economically sensitive to the price. What they care about is how much is going through their pipes. They're just taking tolls. So the more that goes through the pipes, the more tolls they collect, and the better they do. So that's kind of, at this point right now, that's our one commodity play.
Yes, that makes a lot of sense. And just, Michael, on uranium. So uranium is also very abundant, but fundamentally, I think there is this trend towards nuclear. If we compare right now and even 5 years ago, there is a huge switch on how people look at it. And these long-term contracts that the utility companies are signing help us to predict the future demand, at least in a way. What's your take on uranium?
I like it. I think it's a really tough play, though, in the short run. The problem is these nuclear facilities, between permitting, regulations, and then actually building them, they can take up to 10 years, if not longer. So, natural gas, I'm buying the pipeline. I'm buying into something that's benefiting today. Uranium is going to take a long time to get from here to the point where it's creating revenue. And that's the difficult part. And you're going to get a wild ride between here and there. My guess is if you hold it from now to when these facilities start coming online, it's going to work out great. But how many uranium mining companies can survive that? That could be a long stretch of time where they're spending a lot of money trying to get it out of the ground, trying to, process it, however they do that. And if that demand just isn't there yet, that can be very problematic, and they just run up too much debt and can't service the debt. So I like the idea, and I know some of these like nuclear companies have done really well, and that may be something. We've looked at some of them, and we may be very happy to buy them if we get a big correction in some of those prices. But right now, given some of the high valuations and that very long runway between today and when their product is in real demand is problematic.
Yes,
Only at the right price. It's all about price.
yes, I think right now the cost of production on average is about $65 per pound. And I know there are companies like Kazatomprom, they're much lower. But as a whole, even at the current uranium levels, most of the companies are feeling okay. So there is some incentive for more production as well, which in future would increase the supply as well.
Right. Yeah, I'm not necessarily disagreeing. I just think it's a much murkier path than the natural gas path. And if those prices of some of those stocks like Cameco, for instance, come down, that may be something we would go into. But right now, from a risk reward perspective, I'm just saying I like the natural gas part of the energy infrastructure. It's a little cleaner. It's a little easier to forecast, a lot easier to forecast. So, but I'm not against uranium per se. I just,
Yes, that makes
it's
that makes a lot of sense. And with Cameco, it performed so well, which again shows why you want to own the biggest and the best companies as well in the sectors like these. So, Michael, I would love to talk about the portfolio structure. So, of course, portfolio structure depends on who you are, at your age, and a lot of other parameters. But I suppose, as a whole, in the current environment, how would you look at diversifying between different assets in what's happening right now and what you're seeing for the next 3 to 5 years?
so I like diversification is important, but you shouldn't diversify for diversification purposes. In other words, don't just say I need to own one of everything. You need to, the way we think about it is we want to own assets that have favorable risk reward ratios, and we prefer to own assets with those favorable ratios in different industries with different ways of making money, different correlations to the market to each other. So big fan of diversification, but when it's done right, not just to say you're diversified. And today's a good example of that. In our portfolio, we have some of these high flyers. We have NVIDIA and Palantir, for instance, but we also have Duke Energy. We have Eli Lilly, AbbVie, which are up decently today. So we have Procter Gamble. So our portfolio is made up of some of these stocks that have been doing really well recently, some that have been lagging, but we look at our portfolio as kind of the bottom line, and this is hard for our clients. They look at their account and they say everything's great, but why are you losing money on that one thing or two things? They always focus on that one red line. And we say, look, it's part of the structure. Bonds are doing extremely well today. So that's really helping us out. But, 3 days ago, I got complained at because our bonds weren't doing so well. So diversification to me is a way to manage your risk and structure the portfolio in a way so that the bottom line of the whole portfolio can get you to where you trying to get it to be.
Yes, that's for sure. That definitely the best strategy, Michael. So, Michael, I like to ask this question on this channel for the younger audience. If we have an individual who's still at the start of their wealth-building path, and he or she has so many choices between the crypto, the NVIDIAs, the commodities, etc., what advice would you have for that individual, or maybe on how they could make the right decisions at the start of their wealth-building path?
So I would say two things. And I have three kids. Two of the kids have graduated college, and they are exactly in those shoes. So what I tell them is to just set aside automatically. Don't do it yourself, but have your bank wire to your brokerage account every month a set dollar amount. Invest it. Invest it in the long term. Now, if you want to do things like Bitcoin or much more speculative things, have a second account. Let that be your trading speculative account. Have another account that's just your wealth account. This is money that you hopefully will not touch till you buy a house, till you put your kid through college, till you retire. Give that a much longer term runway and keep adding to that. If you want to do more speculative things, that's fine. That's fine. But have it in a separate account. Isolate the two. Don't put them together. And just constantly focus on, you're never going to get rich quick. And if you get rich quick, you're probably going to lose it just as quickly. So, and look, I take personal speculative bets too. I actually bet on sports. That's even worse than betting on a lot of this stuff. But at the end of the day, I also have my brokerage accounts and bank accounts that I know where they're at. I know what they're invested in. I'm very comfortable with the risk and reward in those accounts. And my goal is to keep growing those, because that's where I'm not relying on my FanDuel account to get me to retirement. In fact, if I can even break even any given year, I'm thrilled. So it's my advice to separate in your head those two sets of pockets of wealth.
Thank you very much for that, Michael. And Michael, what's the best advice that you have personally received when you were young and at the start of your wealth-building path that helped you in your career?
So I would like to thank my Uncle Chester for this one. I worked at Fannie Mae a long time ago, and I was moving up quick. Incentive options, and he said sell. I go, why would I sell? The stock keeps going up. It was doing really well. He goes, sell. You got your whole life invested in this company. Your paycheck, your bonuses, your kind of character, your resume is being built on this company. If you continue to do well and the company does well, you'll get a lot more stock options. You'll be just fine. But just sell them when you can, when they vest. And I did. And I sold, I remember the stock went from like 20 to 70 or 80 when I was there. I sold some at 25, some at 35, some at 45, some at 75, some at 80. And next thing you know, the stock was worth nothing. So even though I sold some at 25 or 30, greatest decision I made. So that's kind of my advice, is to separate your wealth investments from your source of income. Again, you're diversifying. You don't want all your eggs in one basket. So my Uncle Chester has since passed away, but I still thank him for that advice.
Yes, that's great advice. Michael, is there anything else that we haven't mentioned that's going on with the economy or in the world in general that's worth mentioning?
I mean, there's a lot going on, in the economy or in the world. And the one message I would just say is, think for yourself. Don't let politics cloud your vision. It's okay to like the president and not be bullish. It's okay to hate the president and be bullish. And I feel like a lot of people's visions are clouded by politics right now, one side or the other, and it can really affect your investment decisions. And you, as an investor, have to break away from that and put your political feelings aside and just think about the positives and negatives that this president, this Congress, and the business leaders that are, whatever they are doing. So that would be kind of a message I'd like to leave with.
So these are all the questions I had, Michael. I really enjoyed the conversation. Thank you again very much for being here.
Thank you. I appreciate it.